Greene is Director for European Economics at Greene Global Economics, joins me in the studio now. And of course, no surprises that this Eurogroup statement doesn't mention anywhere the term or the concept of official sector involvement, but that is what this is, isn't it? And are we likely to see more of it?
Yeah, it's a form of it, and we may see more of it, but not until 2015, 2016. It's kicked so far into the long grass that it's pretty irrelevant at this point.
But they did manage to achieve some things, didn't they, to get the debt-to-GDP ratio to 124% of GDP by 2020 and to get it significantly below 110% in 2022. So this was crucial in keeping the IMF on board.
Yeah, absolutely. I mean, I think that the deal that they came to last night was a pretty big fudge, but, you know, it works in the short term. It means Greece can get its next tranche of funding, won't default or exit the Eurozone in the next couple of months.
Why do you describe it as a fudge?
Well, there are a lot of details that we still don't know, particularly surrounding the debt buyback. We're not sure what price they'll use. Prices have already gone up pretty significantly in anticipation of it, and so the amount of debt relief is still unknown. And also, there's no real premium or sweetener being offered to investors, and so it's unclear how many will actually want to participate.
Okay, so there are clear questions over that, and of course, the IMF has held back its endorsement until this successfully goes through. What is the risk at this point of that debt buyback not quite working or running into problems?
There's definite implementation risk, and if the IMF isn't on board, then they'll have to, plug another huge gap of funding that the IMF otherwise would have been providing.
The fact that repayment deadlines were extended, the ECB profits on Greek bonds are going to go back to Greece. And the fact that they get a reduction roll on the existing loans that they've been given, this all goes, you describe it as a fudge, but on the other hand, it does give Greece for now a small but significant measure of stability, doesn't it? Removing that risk of the immediate risk of a disorderly default.
Yeah, that's right. It does remove the immediate risk, but all of this reduction in debt, it does nothing to actually help the real economy. The amount of austerity that Greece will still have to implement remains the same, and so Greece's economy stands to continue to contract significantly over the next couple of years. Without any growth, there's no way Greece can get out from under its debt burden.
What should they be talking about? They
should absolutely be talking about a debt write-down. Unfortunately, there's no appetite for that whatsoever from the IMF and particularly from the core EU countries.
And I guess one of the reasons that there is no appetite for that is that it would be politically extremely difficult for these creditor countries, thinking about the Netherlands, Germany going into an election year, to try and sell write-downs to their electorate when Spain could be requesting a bailout pretty soon.
Yeah, that's right. It's politically toxic, and particularly in Germany going into an election. There's no way Merkel wants to go back to her taxpayers and say, those loans, by the way, they were really just gifts. Sorry about that. So I don't see it happening anytime soon.
And as long as the markets are relatively calm, does it make a difference that it doesn't happen anytime soon, that we don't get write-downs, that nothing fundamentally changes with regards to Greece? They can keep kicking the can down the road.
Well, certainly it matters to the Greeks because they're continuing to have to retrench, and so it makes a huge difference in terms of the real economy there. But in the grand scheme of the Eurozone, Greece is setting some sort of precedent for other countries. So you mentioned Spain might get a bailout soon, and kicking the can down the road means that investors might worry that Spain might not have a line drawn under it either. But Greece is a small country, so fundamentally it's not really a systemic risk for the Eurozone.
It's not a systemic risk, but as you say, we've seen how the impact of austerity has sort of changed the political landscape in many of these countries, and in many ways this internal devaluation that's going on in Greece, these spending cuts, that's hurting the people. Many economists are saying that austerity has reached its peak this year. Do you expect the situation to improve in countries like Greece, Spain and Portugal next year, or could it get even worse?
Unfortunately, I expect it will get worse. I think that austerity will have only peaked if you believe these countries will hit their fiscal targets, but I don't think that they probably will, given that they'll be going further into recession than is currently forecast. So in upcoming years, I think we'll see them continue to try to play catch up with their fiscal targets by continually issuing more austerity measures.
Megan, what is the risk of this deal falling apart?
There are a lot of moving parts on this deal. It seems like the interest rate reductions and the extension of maturities, that's reasonably straightforward. I think the biggest implementation risk really is surrounding this debt buyback deal.
All right. Thanks so much, Greene, Director of European Economics at Greene Global Economics. Thank you.